Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for May 3rd of 2026. This week we'll start off on the investment side of the equation. We'll get to economics after that. Here we have a chart from UBS looking at first quarter earnings, and so far as the headlines suggest, they've really been better than expected. And you can likely recall a lot of conversation over the last several months of those earnings estimates for really 2026 as a whole have come up considerably. And even when we had some pressure in the market, the earnings estimates had moved up 3 to 5%. And you can see here very clearly that in the red here, we've got the consensus estimates that we're moving higher for first quarter of 2026. And you can see a rather stark jump after the market weakness here. And you can see kind of the line of best fit as we've gone really from the middle of last year, where these estimates have continued to rise. And also consequently, you can see in the gray line, the consensus earnings estimates for the fiscal year 2026 continue to move higher as well, and also witnessed a jump and then really didn't get any kind of a reset here when we had that market weakness a few weeks ago, and have just literally continued to move higher. So there's a lot of optimism in earnings right now. It does create some risk that earnings wind up underwhelming, but if you had been betting on that for the last year, you would have come out on the short end of the stick. Here we have implied dividend growth rates. This is important thematically for what we do. You can see dividend growth rates in the 5% category. This is for the S&P 500. You can see that has moved up to closer to 5% here for the 2026. This is 2025. We had a lot of consistency here in the dividend growth rate. You can see with earnings estimates coming up for 2026 in the S&P 500 that you also see a corresponding increase in the dividend growth rate. Here we have a topic that is pretty interesting. So if you do dividend discount models and you come up with valuations based on the discounting of future expected dividends, there's always kind of a terminal rate that you apply into that formula that gives you the overall value of a stock. And this goes back to Graham and Dodd. This is equity investing 101. And what's really interesting going on right now is that we have the terminal value, that is, it's basically about 75% of the overall value of stocks is embedded in that terminal value, when in a much more healthy environment where you're getting much more robust, like current returns, so to speak, you're going to have less value in that terminal value, which is betting on the come. It's betting on future performance. It's basically implied long-term growth that basically, if in a more normal environment, you have less emphasis on expected future returns that are hypothetical. They're expected, but they're not current returns. This shows a little bit of froth in the market. And you can see here the relative importance of that variable in explaining the next 2-year PE ratio. You can see that long-term growth is very, very influential. And so the key takeaway here is that if growth, expected growth, call it 2, 3, 4, 5 years from now, doesn't materialize, that takes away a lot of creates an air pocket underneath that valuation. Here we have forward EPS, which we've already talked about, moving higher. This is the aggregate number for the S&P 500. Here is the year-over-year change. You can see, it wasn't too long ago that we were looking at fairly stagnant growth in earnings, but you can see that is now over 20% on a year-over-year basis, and that is propelling. It's trying to challenge the PE ratio, because obviously if your earnings move higher, and your price isn't changing, then that PE ratio goes down. But we're still above 20 times. We're not as expensive as we were. But even with a 20% growth rate, we're still looking at probably about 22 times forward earnings. Here we have a slide from KKR's recent research piece. You can see, I think this really speaks to what the consensus estimate is looking ahead. So, we've got in this darker color, we've got the last 5 years. In the purple, we've got the next 5 years. And so these are expected returns in the index. And so the last 5 years, we've had 17.5% roughly return in the S&P 500. But looking ahead, the expectations are much more muted, looking for only about a 5% return. Bond index, we haven't had that much return. We've had a lot of volatility in the bond indices, and this is also global, so it includes non-US. And then here, if we look at some of the private related returns, we've had real strong returns in private credit, private equity and private credit over here. The expectation is that those returns are not going to be as robust, but they're going to be greater than the S&P 500. And then private infrastructure with data centers and everything else included in that, expected to return over 10%. And then private real estate expected to witness a rebound. And so when you look at really the right side of the chart here, it gives you some perspective on why we think it's going to be important to include more privates. If you assume that your expected returns in the conventional markets are going to be lower, you certainly would want to augment them with returns in the private side. Understanding that there are some liquidity constraints in all of these categories right here, but there are many more products and ways, expressions and funds that you can invest in that can give you some of this exposure without making those direct investments themselves. Here we have another chart from that KKR research, which really is near and dear to my heart, from a left brain point of view. So on the x-axis here, we have realized annual volatility. So obviously, the numbers get larger and larger. So this is much higher volatility at 20% than low volatility down here. And this is 20-year realized annual return. So if we look at the traditional asset set, and that's just, common stocks, bonds, etc., this is kind of our efficient frontier. And so, it makes sense. The more risk that you take, the higher your return should be. And so this is kind of a basket of those traditional investments. Now, if you add private equity, and this is just private equity, not private credit, then you get a more efficient frontier. And so the idea here is that you're getting more return versus here, you're getting more return for the same level of risk. And that is the point that I've been working to make over the last, really the last couple of months, that this argues for increased exposure in those alternative categories that are now much more comfortable residing in equity and within the fixed income sleeves of our investment policy. Interestingly enough, as we plot along here in 2026, that we're looking at a really, really good year in initial public offerings. So we've had, some tough years heretofore in the IPO markets. This year looking to be much more robust, and certainly more robust when you're talking about the mega IPOs, the very large company public offerings in 2026. So that's good from the standpoint that it adds more equity supply on the market. And it comes at a good time when there's a lot of liquidity looking for a home on the public markets. Here we have inflation, a quick check-in here. This is from UBS from roughly about 10 days ago or so, 2 weeks ago. And you can see that as we look at CPI, and this does a really good job of kind of explaining that recent rise is really due to energy. That we've had energy prices because, of course, we've got a conflict going on in the Middle East and in the Persian Gulf right now, and that's causing higher prices at the pump, etc. We've got a chart on that coming up, but you can see here that energy is really the main culprit here on why prices have moved higher. Looking at oil kind of in a broader sense, however, this is one of the reasons why we haven't probably seen more inflation than we have out of this Persian Gulf conflict, and that's because that the concentration of energy usage has declined over time. The intensity of usage, I'll call it, of oil has certainly gone down. In 1965, we had 5.3 barrels required per $1,000 of global GDP, and they're calling it oil intensity here. And that has gone down to basically about essentially 0.3 barrels. And so a very large tectonic shift. We had major increases in energy intensity, certainly after the OPEC embargo in 1973, and that's just continued over time. And certainly, when you look at this time frame, we've had the advent of alternative sources of energy and things like that. And frankly, we've also created devices and we've created transmission mechanisms that have made energy transmission much more efficient and the energy consumption a lot less intensive. Thought I'd do a reminder of a chart that I've shown you at least a couple times in the past, and this is really helpful. This data goes back all the way to 1949, and it shows you the preponderance of bull markets versus bear markets. And obviously, bull markets are in the blue, bears are in the red, and you can see clearly that we tend to spend a lot more time in bull markets than we do in the bear markets. And you can see up here, the averages, bull markets average about 5 years. And within those 5 years, you tend to get about 250+% in total return. Now, when you look at bear markets, that can be pretty visceral, and it can feel really bad at the time, but they generally don't last more than a year, even though you do have some pretty reasonable drawdowns. But again, if you look at it, very few times do you find yourself in prolonged bear markets. And there are clearly some exceptions to that, but generally speaking, when you have a relatively weak market year, you tend to follow that up with a very strong market year after that. And just again, if you're looking at it from a long-term perspective, more often than not, you're going to be in good shape as long as you don't get emotional during the moment and you have that long-term view. Here we have some annualized returns looking at presidential cycles here. You can see it really doesn't matter if you're talking about Democrat or Republican in the White House. You've had pretty good performance. This data goes back roughly about 15 years or so. And there's other data that kind of digs in a little deeper, and when you get to midterm election cycles, that you tend to get a little bit better performance, coming out of those midterms when you have some, a little bit more certainty heading into the last 2 years of a presidential cycle. And, things like that are helpful. I wouldn't necessarily use them as a guide. Again, just like the last slide, if you have a long-term horizon, it really shouldn't matter who's in the White House. It really depends a little bit more on the economic backdrop, which ultimately filters into asset prices. And then translates into that market cycle. And again, just to show you, it really hasn't mattered who's been in the White House. So we've got enough time under our belt from the Iran conflict that we can begin to draw some conclusions and some observations on what has been most impacted and how and to what degree. Here we'll start off with gold. We had a little bit of recovery off the low, but the gross drawdown was something closer to 17 and a half. We're still down around 10% from those pre-Iran conflict levels. You got, developed market equities here down around 3.7%. Those have recovered as well. And then even treasuries are net negative here. Corporate bonds and 2-year treasuries Emerging market equities have performed a little bit better, slightly positive. You can see that there's been a lot of volatility, as has there been with gold, frankly. And then U.S. equities, of course, we know we've been tracking that volatility, and we still have so much net positive liquidity hitting the market that despite this volatility, that you've got positive returns in the equity categories. But again, developed markets, international negative, U.S. positive, emerging markets a little bit above the flat line, and these two categories were really hot last year. And then again, bonds are kind of basically treading water to a slight loss. Have a few macro things here that caught my attention. We've got the International Monetary Fund uh, recent World Economic Outlook from this past month. And their forecast is that global debt is going to reach 100% of global GDP here within the next several years. And, and that does concern me. This is mortgaging our future and putting the burden on our next or rising generation, if you will. And you've got increased debt loads. Obviously, the U.S. is playing a big part in that. But again, when you have this kind of rate of growth in overall debt, just think about the implications. You're going to have more debt service. So you have more of your federal, at least in the U.S., your federal budget that's going to have to be dedicated to servicing that debt. So you have higher interest and principal payments. And then it's just really going to lead to slower overall growth. And so if you switch and just take out the global, kind of like hold that off to the side for a second and just look at the U.S. public held debt as a share of GDP, you can see how that is contributing into that global number and how much that has risen in percentage terms in a very short period of time. We've got wage growth updates here. Very interesting that we're getting some positive wage growth. And you look at, the overall number is moving higher, and that, the major contributors to that, you've got people that are actually switching jobs. And, for a long while here, for multiple years, that was not benefiting people that were switching jobs where they could get higher wages, but it certainly is now. So we're seeing kind of the scarcity of labor kind of kick in a little bit that frankly we hadn't seen in really a couple of years. And then you've got people that are staying in their jobs, and this is a bellwether. This represents people that are switching jobs to ostensibly get a better deal. This represents people that are in their jobs getting raises, and so this is a positive sign. We still have real positive wages. It would be these wages net of inflation. The fact that they're moving higher helps to support consumption, helps to at least offset the negative trends that we're seeing in savings. We'll talk about that, but a positive development for sure here. We have some regional data here. We've got Richmond Fed, their manufacturing activity index is positive. That is a new development. You can see a whole host of negative or contractionary readings here over the last year, a couple of years really. You look at expectations, they are certainly anchored in the positive. We've seen that positive trend for some time now, even though they're off their peak, that this is still pretty positive. And then current conditions on new orders, we see a definite uptick here. So positive reading from the Richmond Fed. So last week we just got the first reading of first quarter GDP or first quarter economic growth. You can see a very colorful chart here, trend lines going back several years. And this is the first reading. So we got plus 2%, positive 2% economic growth. The estimate was a little bit less than that. We'll get two more revisions before we get to a final reading for first quarter GDP. And you can see here that that 2% comes into play right here. You can see the benefits, the contributors to that growth were personal consumption, as has been the case. We've had continuing personal consumption, even though it might be less than some prior quarters. We still had business investment positive. We had government spending, which has been a little A little lumpy, I guess, to say the least. That's still a positive contributor, and we also built inventories. And what's been holding us back, or what held us back in the last quarter, at least by virtue of this first reading here, is net trade. And this is net exports, is just basically the gross amount of exports minus the gross amount of imports. And so we have imported a lot of technology goods. You'll see that in a second. And that was a big anchor this quarter, as was to a lesser degree, residential investment. Here we have some of the individual components of that GDP number. And I like this chart because it shows you the 10-year average and where we are in terms of our current trends. And so you can see here, personal consumption, very important to the overall economy, not surprising. Over the last 10 years, that's contributed, I'd say, at least 2/3 to overall growth here. But you can see, looking at the 1-year average, that contribution was less. And if we look at the first quarter of 2026, as I said in that last slide, it was positive, but not as strong as it has been. And so we've got business investment, which continues to move higher. We've got expectations. The caption here is artificial intelligence. We've got capital spending for data centers and other things of that ilk. And then residential investment, as we showed you, was a drag, as was the net trade number, which was a big anchor the last period. But government, we had, this is more of a timing issue where we had the government shutdown, and so this is kind of a recapture of some of that loss. I wouldn't necessarily assume that the government spending levels are going to be, any higher than what the 10-year average is, and I would just kind of chalk that up as essentially to an anomaly. But and then we talked about net trade, and then inventories were slightly positive, or were more than slightly positive, and somewhat beneficial to our last quarterly reading. Personal income, positive here. We see real disposable income. This is the rate of growth. So, even though we had a positive reading here in personal income, when you dig down a little bit deeper and you look at real disposable income on a year-over-year basis, we're positive, but only slightly so. And if you look at it on an annualized basis, we've had a decelerating rate of growth in disposable income. Here we have real personal consumption expenditures. So this is PCE spending. You can see that you've got durable goods remaining higher. And we know that number is probably a little bit higher than it otherwise would be, just because we have the impact of tariffs in that. And we have non-durable goods moving higher as well. And then, of course, services has been very, very steady over multiple years. So that consumption is driving that savings rate down. Right now we're 3.6. You can see how this has oscillated over time. This I would just back out as a complete anomaly because of all the transfer payments. And, this is just, it's too messy to even really dig into. But suffice it to say, that there was a period of time where these savings rates were above 5%, and that's certainly not the case now, as people are spending into their savings to maintain their levels of consumption, even in light of increased prices at places like supermarkets, etc. Here we have PCE, Personal Consumption Expenditure Price Index. We did have a bump this last period. We had core prices, if you look at, you back out energy and food, that was about 0.3%. That's pretty much in line with the estimates, as was the headline number. But so, we were looking for a bump in inflation. And you can see that this number is a little bit less than what we saw last prior readings. It is higher, though, than a lot of the readings that we've seen over the last couple of years. You come over here to the right, you see PCE inflation trends, and you can see that basically you look at year over year about 3.2. Again, that's 3%. It's higher than the 2% target. We've been in this range for some time, so this is not like a real tectonic change here. But you got your 3 month annualized number that's clearly above the year over year and the 1 month annualized. 6 months, about 3.7. So you have seen an uptick here, and it'll be important for us to monitor these trends. And it's basically taken all the rate cuts off the table and, frankly, has introduced the notion that we might have a rate hike. And I think it's too early to tell that right now. We've got a new Fed chair who has a proclivity towards wanting to ease, but he's not going to have the votes on the Federal Open Market Committee. But we have a lot of things in flux right now with regard to interest rate policy. Here we have that policy rate, which you can see here. We plateaued. We've come down. We've got a couple of bouts of easing within this overall easing cycle, and we're kind of holding steady at like 3.75. But it's interesting to note that we've had an increasing number of dissents, and while it has happened, we haven't had this many dissents for quite a while. And again, one of those dissents was Stephen Moran, who is actually rolling off. He's going to be leaving when Kevin Warsh comes on board. But it just shows you that there's a lot more active debate with regard to what interest policy should look like. And again, like I said, the probability of rate cuts is very, very low from this point looking out over the remainder of the year. And to confirm that, we have this chart here. This is the market implied number of rate cuts this year, basically flat, no expectations there. Durable goods orders, slightly positive. They were a little bit ahead of expectations, 0.8%. About 0.5% was the estimate here. If you back out defense and aircraft orders, that number is actually a lot stronger. You had 3.3%. So I'd say this is definitely a good reading. Here we have building permits and a little bit of housing data here. Building permits are down even though new home construction was up for the month. This is the leading indicator, which is certainly not conducive to a robust environment. And as a matter of fact, when you look at it on a year-over-year basis, you've got negative readings across the board. Now, if you look at prices, you see a continued price deceleration, but the price growth remains positive. And as a result, you still see prices moving higher. There was a period last year where we saw price deceleration, actually, or price outright deflation on average home prices over this Case-Shiller 20-city index here, but that has ended. Now we're back in price appreciation mode. Getting caught up a little bit on commodities. Obviously, we've had a lot of shifts here in the year to date. You can see at the very top, and we've got some of these charts coming up, that we've had some really strong moves in some of these categories, whether you're talking about gasoline, which is obvious, Brent crude, which is obvious, we know why. Nickel and some of the industrial commodities have moved higher as well. And cotton, interestingly enough, even though we haven't had a tremendous amount of necessarily core inflation on apparel, has nevertheless been impacted by tariffs. And then this is West Texas Intermediate, but get into some of these other categories like, we've already talked about in the industrial metals and copper being up, but cocoa, wheat, soybean, oils, and cattle continues to be an evolving story there. And really the offsets we've had, natural gas, because of storage levels and production levels have been pretty robust. We've seen declines there, and also in sugar, coffee, although coffee has been extraordinarily high. So again, these numbers are just 1 month, but don't let that fool you. Coffee is on a year-over-year basis is up quite a bit. But anyways, different movements in some of the key commodity areas. Here we have national gas prices, kind of reflecting where we are at the moment. We're about $4.25 a gallon. And you can see the impact of the Iran conflict here. We were actually trending down for a lot of different reasons over the last several years, but probably higher for a little bit longer. We still have those crude choke points, and you also have higher overall Brent crude prices. Here we have some of those key components of the commodity basket that I told you about. We've got wheat futures that have moved higher. You can see that very clearly here, pretty rapid increase there. Cotton futures, again, when you talk about these particular components, weather plays a part, and also to a lesser degree, we've got tariffs and kind of supply chain issues that are at bay here, but a lot of this is weather, and we've just seen some pretty dramatic rises here in cotton as of late. We've got cattle futures, which continue to move higher. You can see this very clearly on display at your supermarket in beef prices. Lumber futures have been trading in a trend, so this has actually been a little bit more favorable. We did see a lot of lumber price inflation that has proven to be sustainable. We're down at these levels, and now the new price deck is somewhere around here when we get down to call it $550 to $600 a board foot, and you can see that we've trading right around our 100-day moving average there. We've got net immigration. This is impacting labor to some extent. You see wages moving higher. You talk about net immigration, this really speaks more to the services and the trades, but you can see very clearly that is moving down. Now, of course, these are estimates. Actually, this is from the Congressional Budget Office, and you can see just a dramatic, literally cutting this, by 90% almost in some cases. A big drop in net immigration has broad implications on employment, on wages, etc. And to conclude today, something I thought was really interesting here. This is a chart that shows, obviously we know what's gone on in Venezuela this year, but the odd thing is that the country gets more kind of net revenue, if you will, from remittances from Venezuelans that are abroad than they actually do from oil revenue. This is pretty amazing. Now, there's probably more that's not being reported here, which is kind of what this line is too. But at least from the official data, this is pretty amazing, and this has been the case for at least a couple of years. And to the extent that turns around here now with the U.S. in control of selling some of those surplus barrels, but remember, this is very thick, heavy crude. It's hard to refine. And it is the kind of crude to some extent that our refineries are geared to actually refine. So expect these numbers to kind of turn around. But it's just hard to imagine that the country last year got more revenue, or in 2023, got more revenue from remittances than they did from the oil markets. That's all we have for today. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.